If you're still funding your home builds with your own money and you're feeling stretched thin, this video is going to change the game for you. If you haven't subscribed yet, make sure you hit that subscribe button. Make sure you hit the bell to be notified every time we drop a new video on how to become a more profitable and successful home builder. In this video, we will discuss cash flow and tying up your personal funds and how that can cause some serious stress for you, giving you no margin for error. Spoiler alert, most small to mid-sized builders are already doing this. I'm gonna show you the proven strategies that myself and the people in my coaching program use to fund their builds without tying up a single dollar of our own money. Why using your own money is a trap. Number one, opportunity costs. If you're locking up your own funds, what if something comes up, like maybe a great deal comes up, some lots come up that you can jump on and buy, but maybe you've got your money tied up in a deal and you're waiting for that to sell. In that case, you may lose out on that opportunity or some type of deal to be able to buy a house and split it up and turn it into several different lots or a rental property. Or let's just say it's not something that's real estate. Maybe it's something in cryptocurrency or the stock market. Or what if something comes up that's not opportunity? Maybe it's something like death in the family that you need to help provide somebody close to you that doesn't have insurance or doesn't have, the means to be able to pay for the funeral and all that stuff. Or what if there's a health issue? You need cash to be able to take care of that stuff. If you have all your money tied up into a deal and you're waiting for that, how are you going to be able to take care of those things when they arise? But number one is opportunity costs that you will miss out on because you have all of your cash tied up into different types of deals. Number two, how it limits your growth and scalability. Well, number one is how are you going to be able to grow a team if all of your cash is tied up into a deal? You're waiting for that cash to come to fruition by the sale of your house, and it's going to come with your cash in there and profits. And then, over time, you do enough deals. Now you'll have enough to be able to do two deals. Now you can do deals, but now you don't have the time to do all of these deals, and you need to start hiring a team, putting the right people in place, and you can't really afford payroll because all your money's tied up in these deals. So now you're up to three deals. Maybe you can only do two deals. And the third deal is going to have to be for cash flow and running your business. So it's going to take a lot longer to do this because you'll have to do several deals just to be able to now be able to do two deals and then several more deals to now even be able to do three deals and so on and so forth. So it really hinders growth and scalability as you're growing. I can remember a time when I was using all of my own cash in my own business to fund my deals, and I was that exact person. I was the head cook and the bottle washer. I was the project manager. I was doing the purchasing. I was doing the accounting. I was doing all of the design, the selections. I couldn't afford to hire everybody because all of my cash was into these deals. And you get to that point where, you know what, you don't have time to take off. You don't have time to go on vacation. I can remember literally years and years and years going by, not taking a vacation and watching everybody else, go off and do their own thing. Yeah, I was making good money, but at the same time, all that cash was always going back into the business, and it didn't allow me to have the freedom to reap the benefits of my profits. And it's an expensive game to build houses and to be able to pay subs and all this stuff. So if you could start to learn to leverage other people's money instead of using your own cash, you're going to see how in the next few minutes, how this can help you scale, how this can create freedom for you and be able to run your business more efficiently. Understanding OPM, other people's money. Now, when you first talk about OPM, most people first think about the word hard money lenders, and those are usually the most expensive people, but they're pretty easy to work with. And if that's all you have to deal with and work with, and it makes the numbers work, then go for it. But there's other means. For example, you have private money lenders. Now, the difference between a private money lender and a hard money lender is going to be exactly that. A private money has their own cash, maybe in a bank account, maybe it's in a old 401k account that they can convert into self-directed funds, or maybe that's into some type of stock investment account or something that they can pull it out, they have access to it, and they can invest into your deals. Now, a typical private money lender, you see anywhere from 10% to 12%, sometimes even more, and anywhere from 0 points all the way up to maybe two, three, four. I've even seen 5 points. Some private money lenders that are more savvy will charge. The best type of private money lenders are the ones that you actually raise and introduce into this type of investment. Let's just say you know somebody who has, let's say, $1 million or $500,000 in cash, and it's sitting in a savings account earning less than 1%, or maybe it's a little better than 1%, depending on the type of bank that they're in, or a CD, or some type of, lower return investment with a bank. And that's all they know, because they really understand the traditional investments. Maybe they have a 401k with a job that they're working with, and so they have this money saved up. Maybe it's from an inheritance, maybe it's from something that they've done to earn this cash, right? So they have 500,000, about this. Well, you talk to them and you're like, well, what are you typically getting as a return on your money right now? Maybe they say 3%. You say, well, what if I can offer you double-digit returns on a tangible asset like my real estate deals, and you invest into this or short-term loans backed by a deed of trust, a promissory note, and insurance policy, and you invest in to get a higher return. Let me show you how that works. So that's a private money lender. So hard money lender works like this. Let's just say a hard money lender borrows money from somebody, and or a group of somebody's, and they borrow it at 8%. They're giving them an 8% annual return on their cash. Okay, now they're lending that money out at, let's say, 12% and 2 points. So now what's going to happen? The 2 points at the time of closing, they get paid immediately. So they initially get that 2 points. And then the delta between 8 and 12 is 4%. So on the back end, they get another 4% once the deal is done and closed, and the principal and interest is paid back. A private money lender, I typically do a balloon payment at the end. Same with some hard money lenders. Some hard money lenders want monthly interest. The next level that you have is typically an institutional type lender. It's not quite a bank. It's kind of like a hard money lender, but they're borrowing institutional money. Maybe they're borrowing from a bank or an insurance company or some type of fund or some type of financial investment type of company, maybe hundreds of millions of dollars every single month. And now they're finding other people. These are typically larger firms. They're finding people like us to lend this money to, and they get a return on it, similar like the hard money lenders do. And then last but not least, we know how banks work. They're the hardest. I typically stay away from banks. They take the longest. They want more information. They are very streamlined, and they just take longer to get the deal done, and they lend less on the deal. Private money lender, most of the times, is going to give you 100% of the deal. A hard money lender may be anywhere from 70 to 80%. Typically, you can see fluctuations there. Institutional, pretty much the same, 70 to 80%, sometimes a little less, sometimes a little more, depending on the market. A bank might be, 50, 60%, maybe 70% that they're giving you on the loan. Now, what you can do is, with any of these ones that don't give you 100%, you can have a private money lender come and do gap funding in second position to gap the difference of what they want you to bring to the table at closing. So a lot of my deals will either have where they fund 100% of them, the institutional lenders, because we're able to buy well because we're able to get the numbers done so well that they will finance 100%. And because I have history with them, as long as the numbers work, I don't have to bring money to the table. If the numbers are a little bit off, sometimes I raise second position funding. I bring that in gap fund, 100% financed on the deal. The institutional lenders I'm going to have to pay monthly payments to. Banks I'm going to have to pay monthly payments to. So those are the different types of lenders that you can work with and kind of how they work. And in another video, we could talk more in depth on how all of that works. Now, if a light bulb is starting to go off, then hit that like button right now. I want to hear from you. Drop a comment below if you're using your own cash to fund builds, but you would feel much less stress to be able to use OPM. How to build funding relationships. What lenders and investors look for. Okay, so some of the things that they're going to be looking for is you want to make sure that you have a good presentation. They want to see that you have architecture, you have engineering, design, selections, permits. They want to see a breakdown of everything. They want to see how much you paid for the property, how much you plan to sell it for when it's all complete. And then what's the difference? How much profit are you making on a deal? So how thin or how thick is the deal? They want to see all these numbers. How you would present this project to a particular lender. Now, I know something that I use and everybody in my coaching program uses. We have a spreadsheet breakdown that shows basically it's a calculator, an analyzer. It analyzes the deal by us plugging certain numbers in. And then from there, we have every single breakdown of the horizontal costs, the vertical costs, POs, we put in there the actual bids that we received, the ones that we're actually going to go with. And so therefore, we can break down all of the pricing per line item so that we don't miss anything on the entire property. So we know exactly how much this property is going to cost us because we have the architecture, the engineering. The designer came in and did all the design and the selections, and then we priced everything out based on the architecture and the selections. Now we have exact quotes that are going to be, exactly what we are going to be paying these contractors to build this house. Maybe we get POs from all of them and we show that we have a PO signed from each one of these trades to our lenders and we present all that. We have solid numbers. On top of that, we put a contingency. The last thing that they want to see is going to be a timeline. How long is this going to take you? Now, when you're going to a lender and you're obtaining a construction loan, at that point, you should already have permits. So the minute that you close on this property, you should be able to stick shovels in the ground and start digging footers and start building. So if you have a schedule built out, you should present a schedule as well. You have a schedule built out, it should show them when you're going to start and when you should complete this project. So let's just say your build time's 5 months. Okay. Then you've done comps. You've showed them the comps that these are the comparables, why this property is going to sell for this amount, why I'm putting these different selections in this house, why I did the square footage, this bedroom, bathroom count, garage, no garage, etc. All of these different things. And you've done that by showing them the comps. So within those comps, you can also see how many days on the market it took to go in contract, how long it took to sell this property. So maybe you're seeing an average days on market is 60 days. So maybe you have, 60 days so it goes in contract, maybe another 30 to 60 days before it closes. So you want to add that timeline in. And we typically do anywhere between a 12 and 18-month loan, depending on the project, the size of the project, the complexity of the project, 12 to 18 months. So most of our deals are 12 months, but some of the bigger homes, we may go 18 months on those ones, just so that we don't have to go back in, make changes, waste time on all that stuff. We're not going to say, oh, this is going to take us 8 months. Well, if it only takes us 8 months, then we only pay 8 months worth of interest. So you want to, put a little bit of padding in there for them. Having these different types of systems and processes build trust with your lender. When you can show them a package that shows every single thing, what it takes to get this project complete from start to finish, that starts to show them, a sense of comfort that they can trust you a little bit more and they want to trust you a little bit more. and they're going to watch this project, go from a piece of dirt all the way to a finished project and then get sold and off to a family. If you can show them any type of credibility packet, which we provide that in the coaching program, a credibility packet that shows history. It's basically like a business plan that shows your experience and how the deal works and the things that you've done. That also helps with lenders. Some big mistakes that you want to avoid when raising capital. First and foremost, do not ever be unprepared. Not having the right numbers and the right parts and pieces. So I've seen so many people, they don't have architecture, engineering, design, selections, permitting. They don't have everything priced out and they just take a guess and they say, okay, this is going to cost me, $300,000 to build this. I paid X amount for the lot and it's going to take me this long to build it. Well, you know what? That's not going to be something that your lenders are going to feel comfortable with on a wish, a hope, and a prayer. Maybe a family member, close friend might do the deal with you just because they trust you so much. But a typical lender is not going to feel comfortable with that. You want to give actual data. You want to show it in some type of, systematical spreadsheet that you can hand over to them, showing bids that you've collected, that it lines up with everything that you're doing, timelines, comps, pictures, etc. Even a credibility packet helps to get the deal done and help them trust you more. They need to understand the risk involved in this deal. And the risk is that, something happens to you and, the bigger the company you are, the less the risk is for them, meaning they're not relying only on you. If you get hurt or if you get sick or something happens to you, you don't have a team. If you're the only person involved, the risk is a little bit higher. Yeah, there is risk regardless. If you end up, passing away during the project, there is risk, but then there's also team members that can help, finish everything. And maybe, the lender steps in to help manage and get this thing to the finish line. There's different things, but the risk is a little bit less for a lender when you do have a team, you do have different people in place. Over promising timelines and returns is also a big one. You don't ever want to guarantee that someone's going to get X percentage return because anything can happen during that deal. So never guarantee any kind of returns whatsoever, number one. And the timeline, again, pad it. 12, 18 months. Say, a typical deal like this might take us 5 months to build, 60 days to get contract, another 60 days to close on this project, maybe 8, 9 months. But I want to put 12 months just to be safe, make sure that, we've got a little bit of padding in there. Or if it's a bigger deal, you may want to go as much as 18 months. So I hope all that makes sense to you. If you're serious about breaking free from funding your own builds and you want a system to attract the right capital partners, I'd love to show you how we help builders do that exact thing. Click the link in the description to schedule a strategy call with myself or send me an email, info@homebuildingbp.com. And thank you for watching. I hope to see you in the next video.